talk about the current bear market. This is a subject that's on a lot of investors' minds. And the longer this one keeps going, the more it reminds me of the 2-year bear market we had in 73 and 74, which marked the Arab oil embargoes that shut down our economy. And it also reminds me of the tech wreck in 2000 to 2003 that lasted almost 3 full years and just ground investors down till they were totally discouraged. We all want this bear market to be over, but how are we really going to know? Let's take a look at some bear market price bottoms. This first slide shows the 2000 to 2003 bear market. And the 2003 bottom, the last sharp bottom there, marked the end of this bear market. And from there, the market took off like a rocket ship from this V-shaped bottom. In fact, that first upward trajectory for the first 3 months, if it had gone for a whole year, would have gone up 137%. It's called an annualized rate of return. The second slide shows the 2007 to 2009 bear market, and the bottom of that was on March 6, 2009. Again, another very sharp V bottom taking off like a rocket ship. That 3-month rate of return annualized over a 12-month period was 253%. Now that's worth going out of your way for. So you want to be invested at the bottom, but just not before the bottom. The COVID crash on the next slide, 2020, low was March 23rd of 2020. And from that V-shaped bottom, the market took off like a rocket ship. And over the next 6 months was up an annualized rate of 182%. Again, very strong performance. Now, the next slide shows our current market. The low was reached in October, where the S&P 500 index was down about 25% from its high point. Since then, we've sort of sputtered and just gone chopped sideways, really. But the annualized rate of return over the last 6 months was only 31%, which 31% a year isn't bad, but not if you compare it to hundreds of a percent like we've seen in the months following other bear markets. So this suggests we haven't really seen the end of this bear market. It's not typically the kind of market action we expect to see. One of the other things we look for in charting whether we're going to see the end of a bear market is something called breadth, or confirmation of upside momentum. Now, breadth is just measurements of the numbers of either advancing and declining stock issues or the trading volume in those stock issues. The total volume of shares that are trading, strong trading volume confirms a move that we see, especially upward moves. Weak volume suggests we should question that the strength of that upward move may not have staying power. Weak volume is really a sign of not a lot of buyers, but maybe just a few less sellers than normal. So that's why we look at that askance. The 2003 volume marched on steadily after March 12th of 2003 was high most of the rest of the year. 2009 volume on March 10th was 150% of its normal volume and was very high for the rest of 2009. In 2020, after the COVID crash, we saw in 10 of the 14 days after the March 23rd bottom, we saw volume of 150% or greater of normal volume. So these strong volumes suggest those moves have got staying power. They're driven by buyers, not just the absence of sellers. The next slide shows the peak volume this market cycle peaked on February 1st and has declined since then. In fact, the last 10 trading days before our webinar here today, our volume's only been about 91% of normal, which again is weak volume. The market is flat. So this is a divergence from what we normally expect at the end of a bear market. The next slide looks at the number of companies advancing and declining. This is called tracked by the McClellan oscillator, named after the Marion McClellan, who started this in the 1960s. The 2009 high of the McClellan oscillator was quite high and stayed high for a couple of months. The 2020 COVID recovery saw the McClellan oscillator high, but all for a few days in the next 3 months. This slide shows the indicator declining after its initial pop. So again, that's another indication that the bear market probably isn't over. We don't have the kind of trading we could expect. Could I be wrong? Sure. Markets are known for climbing what's called a wall of worry. which means the market's going to go up despite all the boogeymen we see in the bushes. Although for the last 10 days, the market has been down, the S&P 500 index for the year is up about 6%. So for this reason, we keep some of our money in the market. Right now, we're about 2/3 invested across all of Shadow Ridge's strategies, and about 1/3 is in cash or money market funds, which, as Laura mentioned, are now paying around 4%, sometimes as high as 5%. But why don't I think I'm wrong? Okay, why do I think I'm right that the bear market's not over? And that's because the underlying issues behind this bear market that are driving this economy have not gone away. Inflation is still high. Report came out yesterday that said inflation has lowered. That's not really true. Inflation is still growing at 5% a year, but it's growing, instead of at a straight up rate, it's growing a little less steeply. That's all that means. But inflation is still going up, and that's going to put pressure on our economy. The other thing is oil prices are rising due to production cuts in Saudi Arabia. They've taken over 3 million barrels a day out of production in the last 6 months. That's like 3 Alaska pipelines being shut down. Okay, that really impacts the world's oil supply. And if supply drops and demand doesn't drop, prices are going to go up. And demand is not dropping. Demand is still strong. Every bear market we've had has been accompanied by either rising interest rates or rising energy prices. And right now, we've got both of them. The next slide shows total U.S. federal debt. And the reason I'm showing this is we've got a problem, and the U.S. has got more debt, and this chart relates the amount of debt to the size of our economy. So as you can see, we've got a lot more debt than we had even to fight World War II, that earlier spike in this chart. We are awash in debt, and debt is financed with bonds that the government has to sell to keep all the balls in the air as they juggle things.